Welcome to week 4 of Financial Management of Nonprofit Organizations. This week we're going to talk about financial analysis and performance measurement. So now we really get into the meat of financial management of these organizations. We've already gone over what the different types of financial statements mean for nonprofit organizations, what basically are the statements going to tell us. But now we get into doing some calculations and some real analysis to tell us more about the nonprofit organizations. Our learning objectives. So this week we will learn how to interpret financial statements, looking beyond simply a statement of financial position that tells us how much we have versus how much we owe, and the statement of activities and functional expenses, which lets us know what our revenues are, what types of revenues we have, and the types of expenses we have. This week we will talk about the performance measures that we can use that are included in the numbers in those financial statements so they can further tell you what the organization is all about. So financial analysis is the study of an organization's data to determine its health and how the organization performs. We can look at that at an organization over time and between organizations of a similar type. To do this financial analysis, we look at various types of ratios: liquidity, solvency, efficiency, profitability, and diversification. And we'll go into each one of those and what those terms mean. A few words of caution when we're doing financial analysis. It's best to have multiple years of data. It's hard to tell just by looking at a single year how an organization is doing. You really want to look at how an organization is doing over time so that you can get a better sense of the organization. Also, some special event could occur in a particular year that really throws off how you might evaluate an organization. Secondly, it's best to compare a particular organization with other organizations of the same type and in the same general location. So you don't want to compare an arts organization with a community development organization. The profiles of those financial statements of those two different organizations, although both nonprofit organizations, are totally different. And lastly, even when you do compare a particular nonprofit organization to a similar one in the same industry, there still may be variances in how they operate, whether one's more volunteer or oriented versus one that employs a lot of its people. So again, even though we can go through and we can calculate the numbers, there's a lot more that we would need to fully interpret the financial performance of these nonprofit organizations. So we're going to be calculating ratios. So the first one we're going to talk about is liquidity. I think everyone is familiar with liquidity in your own lives. How much cash is available to pay your bills? The most basic of needs in determining financial health. Secondly, solvency. How able is the organization to meet its long-term obligations? Might be okay for this year. Suppose you got a huge grant in one particular year, but that's not the norm for your organization. So we want to look at the long-term ratios that will help predict whether it's able to meet its long-term obligations. Efficiency. How efficiently does the organization run? Is it putting its resources to good use? Profitability. And even though we're talking about nonprofit organizations, yes, there is something about having profitability measures to ensure the long-term sustainability of the organization. Diversification of revenues. How dependent is the organization on one source of revenue? This can be one of the most important ratios in evaluating a nonprofit organization. Too many times I've seen where an organization depends totally on a particular grant from a government organization, and something happens either in the political landscape or just in the contracting landscape that totally eliminates an organization in a year. So diversification is extremely important. So let's start off with liquidity. And we're going to just, if you can bring up your example financial statements that we have from week 3 for this first example. So again, liquidity. How much cash is available to pay your bills? So this particular ratio, the current ratio, is one of the more popular ratios, evaluates the relationship between assets that are available to pay current debts and the level of current debts. So this ratio is simply taking your current assets divided by your current liabilities. So what are current assets? Current assets are things like cash and receivables are the biggest ones, divided by your current liabilities. So that would be your accounts payable and other accrued expenses, and maybe some payroll that has also been accrued. So to have a good current ratio, your current assets need to exceed your current liabilities. So a target is that at the very least have a current ratio of 1, meaning that your current assets are at least equal to your current liabilities so that you can meet them all. And much better, though, would be a ratio of 1.5 to 2 at least. So from our example financial statements from last week, we had current assets of $712,869 and current liabilities of $389,811. So we had a current ratio of 1.83. So that organization did have sufficient liquidity. There are some cautions, though, about the current ratio. Are all of the current assets really current? Specifically, receivables. Are all of those receivables really collectible? I know we do an evaluation of that at the end of the year, but management of the organization should know whether all of those items listed as receivable, well, how soon are they receivable? In addition, are all of the current liabilities included? Especially when you're looking at interim financial statements. There are a lot of things that can be missed during the interim financial statements. A lot of times those interim financial statements are due very close to the end of the subsequent month. How do you know you've gotten all your bills in? How do you know that all of the expenses that should be accrued, things that you expect to happen and that are significant, are included in that current liabilities number? Now we move on to solvency. Solvency is the ability to meet long-term obligations. So one of the popular ratios for this is the debt to asset ratio, where we take total liabilities divided by total assets. And the target is at least to have a ratio less than 40%. So in the example below, even though both organizations have the same total assets, you'll see that their total liabilities are completely different. Organization number one has a debt-to-asset ratio of 34.4%. So it's below that target of having less than 40%. Organization two, again, same total assets, but on a much higher debt level. It has a debt-to-asset ratio of 52.5%. So organization two is going to have to use a lot more of its resources, of that revenue and support that's coming in. It'll have more interest expense, and it'll probably have higher principal payments on any debt that they might have. Another solvency ratio is the debt to equity ratio. And that's where we're taking total liabilities divided by total net assets. So this is telling you how much of your operation on a relative basis is financed by debt versus resources that you've accumulated over time. Again, a ratio of less than 40% is preferable. Using the same organization as in the prior example, organization one, which did have a debt-to-asset ratio of less than 40%, does have a debt-to-asset ratio of net assets of 52.5% versus organization number two that has an even higher debt to net assets ratio of 110%. So again, you can see that organization two is going to have a more difficult time in its operations. But even organization number one has some work to do. And how did I get that net assets number? Hopefully you'll see that from the very beginning when we said that assets are equal to liabilities and net assets, you'll see how I could arrive at the total net assets number for each organization. Next, we're going to look at efficiency. So this particular ratio is a days receivable ratio, and it takes your accounts receivable balance and divides it by your unrestricted revenue. And the target is for that ratio to be under 30 days. Now, this might seem unusual for a nonprofit organization looking at its accounts receivable. And granted, I think this is a hard one to do during the year. It's one that people doing financial analysis will look at more towards the end of the year. Because a lot of nonprofits don't have regular turnover of receivables from a lot of individuals. So a religious institution might have receivables, but probably not a lot to really make it a significant ratio. A school that will have tuition receivables, and normally that balance will fluctuate greatly throughout the year. It'll start off at a high point when the school year starts and then go to a very low point by the end of the year, if not zero. But there are other organizations that have government grant contracts that they bill for every month. So in that particular case, looking at a ratio such as this might be helpful in determining how much are those government institutions, how quickly are they paying the nonprofit organization. Another ratio of efficiency compares the output of resources expended to produce that output. So this particular ratio is the asset turnover ratio. So it takes the total unrestricted revenue divided by average total assets. Average total assets, well, what's that? So it's the asset perhaps at the end of a particular fiscal year plus the assets of the prior year divided by 2. This target is to have a ratio of at least 0.3. The issue that I have with this particular ratio for nonprofit organizations is that a lot of nonprofit organizations are not what I call asset heavy. They don't have a lot of assets. So what does the ratio really mean? So you'll have some nonprofit organizations that will have a building and property, whereas a lot of perhaps arts organizations may not have a lot of assets. So again, financial analysis is more nuanced. It's not just about calculating the number, but it is, you have to have an understanding of the whole nature of the organization. Now we're going to talk about efficiency ratios. The fundraising efficiency ratio. So we talked from the very beginning of this course about fundraising and what effect having a so-called large amount will affect a potential donor's view of the organization. So this ratio looks at your total fundraising expenses divided by the total contributions and grants that you're receiving. So if you have investment income, that's not included. Or if you have other program revenue that you generate, that's not included. So the target here is for that ratio to be equal to or less than 25%. So a lot of people will take fundraising expenses as a percentage of total expenses. I think this tends to be a much better way to look at whether you're spending, quote unquote, too much on fundraising expenses. The next efficiency ratio looks at management and general expenses and fundraising expenses divided by total expenses, which is the more common ratio to look at. It also can be called your overhead rate. And here, the goal is for the combination of those expenses to be less than 25%. Profitability. Now, you might not think of a nonprofit organization as having profitability, but any organization to be able to survive has to take in more over time than it expends to be able to weather those times when the revenue and support may drop under expenses for a period of time in an economic downturn, for instance. So profitability measures the increase in net assets. The profit margin ratio measures the percentage of unrestricted net revenues that are profit to the organization. So it looks at that unrestricted change in net assets, profit in a nonprofit organization, divided by total unrestricted revenue. The target is not to run deficits and have a ratio that meets or exceeds the inflation rate. Now, fortunately, we have had a long period of low inflation, so that does not set a high bar. Also, another profitability ratio is the increase in net assets ratio, which is essentially the same as the prior profitability ratio, but it just looks at it in a different way. So here you're looking again at the change in net assets divided by the prior year net assets. And again, the target is a ratio of 3% or better. Lastly, we have the diversification of revenues. How dependent is the organization on one source of revenue? This can be a killer. We have an organization that is a client of ours that had a particular type of contract to provide daycare to low-income families. And there was a network of these organizations around the city. There were about 5 of them that serviced different areas of the city. Well, a new administration came in and decided, I think it might be better to consolidate those contracts under one organization. And so that is exactly what happened. Not only did it not go to any of the existing 5 organizations, it went to a totally different organization. All of those organizations are now scrambling to determine what's their mission and what will they do to survive as an organization. So diversification of revenues, extremely important. Another example of diversification of revenues, at times a state will go through budget impasses and they can't pass a budget. And so for those organizations that might be dependent on state funding, if the state does not pass a budget for 1, 2, 3, 4, 6 months, some organizations will go out of business. The common size ratio just measures the proportion of a particular revenue item to the total revenues. So you really don't want to see a particular revenue be 90% or more of your total revenue. Even 80% or more can be dicey. But again, this is another situation on whether the target depends on the goals of a particular organization. There are so many questions that can be had when you are analyzing an organization. And I've just listed a few of these questions. Should the nonprofit have a line of credit? Suppose you do have a nonprofit where they have government contracts, but they're not paying on 30 days. They might be paying in 45 days or 60 days. You might want to have a line of credit. Are the investment results reasonable for an organization? Suppose you have an organization that does have a significant investment portfolio. Are those investments achieving a reasonable rate of return based on the market? Number 3, do we have a sustainable mix of programs? Everywhere I go now, people are talking sustainability. Do you have a mix of donors, if not a mix of programs? Are you dependent only on a few donors? Are some of your donors on which you depend a part of a vulnerable population should the economy take a dip? Number 4, is our cost per mission of output competitive? Just like in other areas of business, there can be competitors to your nonprofit organization. Are you being as efficient as you need to be? Or will you have another nonprofit organization be more efficient, be able to reach more people, and then maybe make your nonprofit irrelevant? Number 5, what short-term measures, and I might as well say what long-term measures, are best for the use of a particular nonprofit organization? Suppose you really don't take receivables, then that one's not one for you. But take a good look even at the liquidity ratios. Even though we say in general current assets divided by current liabilities, Really look at the components of those current assets. Which one of those are really liquid? Do you have some CDs that are included in those current current assets? Are they current if it's a 9-month CD or a 6-month CD? Number 6, now that we have the ratios, how do we improve or change our operations to make sure the organization is sustainable? Once you've calculated all these numbers and you say, okay, this means this means that, then what are you going to do about it? Please let me know if there are any questions. Thank you.